Good afternoon, Dr. Faruqi. This is Sean Duncan. Me and Shelby Elo will be running a presentation over Verizon Wireless. We picked Verizon for our semester evaluation, so I'll be starting off with the company background. Verizon Communications was founded in 2000. It was formed on a merger between Bell Atlantic Corporation and GTE Corporation. Both companies' origins dated back to the 19th century. This merger was one of the largest U.S. business mergers in business history. GTE was also one of the largest communications companies in the world with over $25 billion in revenues in 1999. Bell Atlantic was even larger than GTE, if you could imagine, sitting at over $33 billion in 1999. I did not know that I was older than Verizon Wireless until we started this project, which is quite frankly amazing. The two companies were basically running the telecommunications field. So coming together, they thought would be a good merger. So for instance, right now, sorry to go a little off topic, I'll get to it a little bit later, but T-Mobile and Sprint are thinking about a merger here soon. So that's something to look out for. Anyway, the origin of the company name goes back to the Latin word veritas, meaning continuity, certainty, and reliability. Verizon is one of the largest telecommunications companies in the world. It was added to the Dow Jones Industrial Average in 2004. It's the #1 global media technology company for creators, advertisers, and consumers on a mobile-first network platform. So, for instance, over 70% of their revenues is based off of wireless business, which is amazing. 70% of their revenues are based off of wireless platforms. Unbelievable. The founders of this company made a great living off of this. Since 2000, when the company became one, Verizon has only moved up within the industry, and it is right below AT&T in the industry. The industry that Verizon is in is communication services. The big four in communication services is AT&T, T-Mobile, Sprint, and Verizon, obviously. The four companies are giants in the companies. They outperform almost every company in the sector. So what I'll be looking at here when you're looking at the sector for an investor is, if you want to invest in one of these companies and invest in their stock, you're going to look at their sector rating. And their sector rating, according to Morningstar, is 0.94. That is a fair rating and a steady performer according to Morningstar, which is awesome. So if you're an investor and you're looking at, we were looking at Verizon, we're going to look at the sector rating of 0.94 and figure that these are steady, that Verizon is a steady performer, but it's not a great performer, but we're going to get steady returns each year with Verizon because everybody uses their phone. I say in the next 10 years, only the phone industry is going to get even more ramped up, and clearly 70% of their revenues are from the wireless business, so they're looking good there. The two main competitors in their sector for Verizon is 1, T-Mobile, and 2, clearly AT&T. The Morningstar update had good but not great news about the future growth and earnings of Verizon, but it had great news about T-Mobile and their future earnings and growth, which in their industry is okay, but with the merger of T-Mobile and Sprint, then Verizon could be in a little bit of trouble, because if they merge, then they may overtake Verizon in market cap and net income. So a couple things that have been happening in the industry, like I said, of the T-Mobile and Sprint, it will cause concern because if T-Mobile and Sprint, then they will most likely overtake Verizon, if not AT&T, in market cap and in income. That has not happened yet. We don't know if they will overtake them, but the presumption is they will. And if Morningstar sector update came out earlier this year, if they were already predicting a merger, then it's, if not a couple months, if not a couple days from this happening. And another thing that affected Verizon in the industry, that happened in the industry, was the merger between AT&T and DirecTV. So the growth and AT&T wanted to grow and diversify their revenue. So Morningstar was fearful of this acquisition because of the minimal benefits to the telecom business. One of the reasons for concern with Verizon is a smaller firm within the industry, and that is T-Mobile. According to Morningstar, they present an investor more upside out of the company in the sector, giving 3 years of increasing wireless service revenue. So clearly, if they were to merge with Sprint as well, then their wireless service revenue would probably overtake Verizon. And if 70% of their total revenue is coming from the wireless business, and T-Mobile and Sprint merged, then their wireless service revenue might go down to probably, worst case scenario, probably 60, 65, wouldn't you say, of their total revenue being based off the wireless service. So it's a big thing to look out for if you hold stock in Verizon. You want to look out for T-Mobile and Sprint, because if they merge, then that could be a really big halt for Verizon. So now I'm going to get to in-strict value versus market value. So when me and Shelby did our calculation, we had an average stock price on our in-strict value of $53.64. So $53.64. And at the time, the market value for the stock of Verizon was at $53.31. So we came up with a undervalued assumption, but we did not know that the stock price currently now, as of 10/19, is $55. So it pretty tells us and tells me that our in-strict value of $53.64 that we came up with stayed true, and that our assumption of an undervalued stock is correct. So Verizon, from a different perspective, because having two numbers that are the same value pretty much means that an investor can feel safe with his or her investment and will be safe, that there is not a whole lot of risk with Verizon, and Verizon doesn't Verizon does not present an overvalued stock to the investor right now. So really, based off that, based on an undervalued presumption for Verizon, me and Shelby said that we would repurchase some stock. We do not think that Verizon offers investors an overvalued investment. So in that case, Verizon is going to have to repurchase their stock in order to meet their expectations. They are slightly undervalued, but I would lean more to fair rated value, but not dramatically undervalued. So they do not need a major overhaul of repurchasing their stock. I think they should reduce their outstanding shares, which would appeal to investors because it makes the earnings per share increase and the return on equity to increase as well because of the fast money the company will get by the investment. Stock buybacks increase. Also, they increase the value of the remaining shares because there is now less common stock outstanding, and the company earnings are split amongst fewer shares. So pretty much Verizon needs to get a head start on fellow competitors during this slow market, because right now the market is very slow, and this would allow the company to generate consistent revenue growth and doesn't seem to be in a bad position even with this bear market. So if you can increase your revenue growth and increase the value of your stock right now, then you're in good business. So repurchasing your stock would increase the value of your stock because it would make the stock price go up. And right now the stock price has gone up for Verizon, so I assume they're listening to repurchasing their own stocks idea that I have for them. I doubt that. You don't know, but I think they're in a good position to repurchase their stock. I don't think they're overvalued at all. How would I improve this company? Which is a great question. Obviously, I would repurchase their stock so they increase their earnings per share, and so they increase the value of their stock, so more companies can look at their stock and say, hey, they're trying to increase their value while they can in this bear market, because if this market keeps up like it is, then if you're getting Verizon at $55 rather than when they go up to about what if they go up to 60 to 65? Then you're in real trouble if they go up by $10 in the near future, which could happen. You just don't know. This market the market's already doing slow as it is right now, and if their price is going up during this bear market instead of going down, then you need to jump on this $55. So how would I improve this company? I would try to get a merger with a company along the lines of DirecTV like AT&T did, so they can diversify their portfolio and where their revenue is coming from. Like I said earlier, if T-Mobile and Sprint form their merger, then the wireless business is going to be a problem for Verizon, because as is, T-Mobile is already increasing their revenues through the wireless. If they form a Sprint, then you have your Sprint users and your T-Mobile users, so you're talking about two big groups of users, and if you combine those two, then you're talking along the lines of Verizon and AT&T, and if Verizon can't diversify their portfolio where their revenue is coming from, then they could be in real trouble, because now they're only going to have one source of revenue, which is the wireless business, which is a great business to be in right now because of the time of age. But I would look for Verizon to merge with a company such as Charter Communications. I don't know if they've merged with someone yet, but it's just an idea. I think it would be a great way for Verizon to diversify their portfolio and where their revenues are coming from. I hope you enjoyed this presentation. Thank you very much, and I'll see you soon.